Trading price action trends. Technical analysis of price charts bar by bar for the serious trader. Chapter 3. Breakouts, trading ranges, tests, and reversals. The market can only trend or range. When the market is in a trend, traders will feel a sense of urgency or wait for a pullback. When the market is in a range, traders will start to feel confused on which way the market is going. So if you feel urgency, we could be in a trend. If you're feeling confused, we could be in a range. This is a quote directly out of the book. One of the most important skills that a trader can develop is the ability to reliably distinguish between a successful and failed breakout, a reversal. So I took a screenshot of last month because it had a good example of a trading range and a trend. This whole chart is comprised of trends and trading ranges. This trading range ended up being bull flag that broke out and went into we had a bull rally after we broke out of this bull flag. When the market was sideways, it's easy to buy range highs and sell range lows. I've definitely been trapped. I'm sure a few of us have all been trapped actually. I don't know anyone who hasn't been trapped in a range before. But when that happens, traders can get confused, and confusion will leave traders hitting out of their position, and the breakout will fail. Reversing, which is a hallmark of a trading range, is reversals and confusion. After we get a breakout from the trading range, a trend takes place, the market cycle resets, and a sense of urgency happens. When traders are feeling a sense of urgency, the market's breaking out and it's running away from them. They're typically waiting for a pullback, and I'll suggest it's best to just get in with so if you trade one E-mini, you could trade 2 micros, that's 20% of your position size. If you just trade a really, really small position size and get in the markets and don't miss, even if you have to catch a couple points, at least you caught a piece of the trend. Trends have high probability setups, but their risk is usually bigger. Here's a trading range. This is a zoomed in picture of the chart we just saw. We're looking at this blue box right here. So we start left to right. Market sells off, strong breakout, but it reverses. Next day we have a gap up, and bulls start to channel, but it ends up being a wedge top that sells off. This wedge top looks strong for another leg lower. Sellers, small pullbacks, but when we get to the previous swing low, it reverses higher, and bulls actually get a new high that day. It's easy to get trapped here thinking the market's about to spill over, but then the reversal happens because we're at range lows, so it's buy low, sell high. After bulls make a new high, the market actually gaps down and goes for 2 legs lower. So leg 1, pullback, leg 2, pullback, leg 3. Leg 3 can be a wedge bottom, so here's a wedge. Let me draw that in. So here's one wedge, and then here's the wedge I just counted. Put leg 1, 2, and 3. So this leg didn't really reach that bottom, so it's not the best wedge, but here's another wedge. This was into support, so buy low, and bulls get a new high of the day. And this high leads to sideways price action. So this is a trend. We're looking at this green box here. The previous slide, it was this blue box, and now we're looking at this box. When the market breaks out of a trading range, it resets the market cycle. So this trend is resetting the market cycle. It's a strong trend, and buying high, even if you bought the high of this range here, holding, you could get out for 1 point, you can buy more, scalp your second entry and get out at your first entry, break even. You could buy this high and you'd make money, so which is different from a trading range. So if we're in a trading range for a couple of weeks and you get used to buying low, here you can kind of buy low, but you'd be waiting for a long time because low is relative. Low in a trend is not low in a trading range. With that being said, these pullbacks are trading ranges on smaller time frames, but buying low here is buying this breakout bar. It's buying here, which is a bull flag. So the bull flag I'm looking at is this the pull. This is the pull, wedge bottom, and it breaks out. You can start to buy the highs of these bars, and you make a few points, or you can hold for a swing. Trends, we have to trade smaller because the stops are wider. Then we can scale in lower. Trends also have gaps. So from here to here is a gap that's open. From here to here is a gap. Here to here is a gap. There's lots of gaps all over this chart. That's trending. That's a characteristic for trending behavior. In ranges, gaps close. A trend starts with a strong breakout. The breakout could be big or small. When the breakout is taking place, we want to see good closes and trend bars in the direction of the breakout. As the breakout continues, the pullback starts to get deeper. Pullbacks and reversals look the same because reversals start as pullbacks. Deep pullbacks show two-sided trading. Two-sided trading is the start of a range. The end of a trend is the start of a range. To measure the strength of a trend, draw trend lines. So here's an example of a bear trend. Bar 1 is breaking out far below the EMA. It also breaks out past these bars right here. Bar 1 also gets followed through, closing the gap. This gap up is closed with these bars here. The follow through bars show that bears are willing to short lows. Bar 2 is more of this whole thing, and it's showing the channel face. It's the second part of the market cycle. After the first pullback, which is it's shallow compared to the rest of the pullbacks, this starts the channel face. So first pullback, now we're in the channel face because that shows two-sided trading. This was a strong enough leg this was a strong enough leg that led to a new low of the day. But this pullback right here was deeper than this pullback. You see how it's shallow, testing right here, and then it sells off. And this pullback has more overlap, more bull bars. It's more of a wedge top pullback, led to a new low. And now look at this pullback, a strong break. Look at this bull bar. This is the biggest bar that bulls have put in above the EMA, and it's late in the day. The day is about to be over. So as the trend was continuing, the pullbacks were getting bigger, and the bigger the pullback, the more chances of a reversal. The last part of the market cycle is the range bound price action, and that's what we have from here to here. So let me circle that. So in reality, bulls made money here, so we were in a range, but had more selling pressure because of the breakout. The market went completely sideways around here with this double bottom. So depending on how much pressure is being put out by the bears and how deep the pullbacks are, we can start to see who's in control. There are more bear bars below the EMA. All bull bars are getting shorted, but as the trend progressed, bulls started to get more and more bars above the EMA. This is the same chart we were just looking at. I wanted to show you guys the trend lines and how they were getting wider. So here we have a steep trend line. It's the first breakout. Bulls break the trend line and sell off again. The second trend line right here is already getting, what is the opposite of steep? Less steep. It's getting wider. It's getting more flat as the trend goes on. And if we were to continue this, eventually the bulls would buy around here and this would just become a double top. Trend lines aren't the end all and be all of everything. Al says in his book, I can't remember if it's the blue book or Trend's book now, but he does say like he draws the trend lines, then deletes them or erases them, and he just kind of has them there to keep himself on the right side of the trade. Don't quote me on that, but it is in one of the books about how trend lines are just more of a visual idea. It's not the end all and be all, but trend line breaks are great. There are other trend lines all over this, but we're just focusing on how to measure trend lines during a trend. And this is the bear trend, and the longer it goes, the flatter it gets. So here's an example of a bull trend. And we can see the range bound price action a little better here. Here's that strong spike. So I labeled the spike as bar 1. Then we get a pullback here, which is bar 2. Look at the depth of the pullbacks as the trend progresses. Shallow pullback, new high. Okay, we have a shallow pullback bounce off the EMA, but we go sideways again. So this pullback's even longer. It's more of about a 1 hour range, and then we break out. And look at the final pullback right here. It was really long, and it led to a range open the next day for more than half the day, so about 3 hours of the day. So as the trend was going, bulls had to start taking profits because their risk was getting too large, and when the risk gets too large, traders have to take profits. See right here how these two bars were far away from the EMA. It was climactic, so bulls start to take profits. We pull back into the average price. They buy the average price and go for a new leg. That's why you can see reversals and pullbacks happening at new highs and lows because people are taking profits at new highs and lows. So when they take profits, the counter trend traders would join in thinking it's a reversal. If it's a reversal, the counter trend traders are right. But if it's a with trend trade, the counter trend traders get trapped. And then when they buy back their shorts in this case, that adds to the trend, adds to the bull pressure. The last part of the market cycle is range bound price action, and that's what we see right here, this is more sideways than the bear trend. The bear trend still had selling pressure, but this is almost a tight trading range. It'd be better to just wait for the breakout, or in this case, it'd be the reversal breakout through the EMA to the downside here. So here are the bull trend lines, and as the trend progresses, the trend lines get flatter. Whenever there's a new high, that's when the pullback started. So there's actually a trend line right here, and these two bear bars break that trend line, create a bull flag, and then go higher. Then we get a deeper pullback that creates a wider trend line. So the wider the trend line goes, the weaker the trend is getting. And then we can see all the way to the end, this is compared to this trend line, the momentum is dying. The trend lines aren't the end all and be all, they're just kind of helping us frame the day. I could even draw a trend line from here to the low of this bar, and that's how we kind of read it. It's like the market's more range bound now, and eventually this trend line would come down and create a double bottom, a breakout, and the bears would start to get a trend line off the screen. A trend starts with a spike in one direction. When the first pullback takes place, the trend will go from a spike to a channel. Channels show two-sided trading. As a channel widens, traders can anticipate a trading range. Trading ranges can test the bottom of a channel. Pullbacks are targets for counter trend traders when the trading range takes place. Tests are when the market goes to prior support or resistance. This slide is showing tests. Here we have a bull trend, and then we have a bearish breakout below the EMA, and bears start to target the reversals. So here we see these swings were put in by the bulls right here, and then as the bears break out, they start testing swings, and they're breaking these are also where bull stops are sitting, so bears are running the stops and gaining momentum. There's momentum right here because there are bull stops right here. Breakout, pullback, another good breakout, and swings start to get tested, these prior bull flags. As the days continue, now if bulls get a successful reversal, they're going to start targeting these highs. That's where they're trapped. So when bulls are buying here, they're thinking it's a continuation and they're getting trapped into buying the high of a bear flag. So when the bulls are buying here, their targets are going to be the swing highs. I get tongue-tied sometimes. So these bull flags, these are all bull flags. That's what we're talking about, is these bull flags. Bears are going short thinking the market's reversing. That's why they're targeting it here, so they're getting out a break even at their original entry. Bears that get trapped here, that go short here, and they get out there. Bulls that buy here, buy more here, and they get out here, break even on their first stop, and a profit on their second entry. Here's that bull trend we saw earlier, but now I've pointed out the bull flag swing lows. So each one of these are bull flags, and at the lows is where bears get trapped. Bears get trapped here, they short more higher, they get out at break even on their first entry, and they make a profit on their second entry. The target for the bears are the bull flag lows. As bulls get the reversal, bull targets start to become the bear flag high. So this double top is a target, this double top is a target, and this double top is a target. Bulls hit all of that. We can see it again that even within the overall range, this pullback, the target was these bull flags, and then these double top bear flags became the target for these bulls. So the market's always moving tests. Reversals signify a change in market behavior. Oftentimes people say the market is reversing. They are saying it's going from bull trend to bear trend or bear to bull. When a trend goes to a range, the market has reversed. It doesn't have to go from trend to trend. A range shows a change in market behavior. A change from trend to trading range. Here is an example of a bull trend. We see the market making new highs and then pulling back, gap up and a pullback, bull rally, and then we go sideways. Here, bulls make a new high and bears make a new low, but it still reverses and bulls get the new high. Every time the market tried to make a new low, so bears are getting short, they end up getting trapped and buying back the shorts, adding to the bull pressure. So the market believes in inertia. The market isn't going bull to bear, it's going bull to range, back to bull trend, range, bull trend. Usually when newer traders talk and say reversal, they think bull trend, bear trend, bull trend, bear trend. But here it's bull trend, range, bull trend, range, bull trend. Here, bears finally start to make new lows. So on this slide, I just wanted to show how long it actually takes to go from bear to bull trend. Look how much overlap we have. It took the bulls a very long time to get that higher low and eventually get a bull trend. So when you would say the market's reversing, it didn't go from bear to bull. It went from a very overlap bear trend to sideways price action for about 2 weeks, and then we broke out into a bull channel. So it took a very long time for the market to change its inertia. Most trading ranges are flagged on higher time frames, page 78. So here's an example of a bull flag. These green dots are just reference dots. This swing low is that swing low, swing high, swing high, swing high, swing high. This sideways price action ends up being a wedge bottom, so push 1, pull back, push 2, pull back, push 3. 3 pushes down, wedge bottom bull flag right here, and it breaks out to the upside. So this range is really easy to get chopped up on, but if we think buy low, sell high, we'd be buying these lows and scalping out until we catch the breakout. This is just one way how lower time frames build into the higher time frames. This range was a good bull flag on the 45-minute. This is the end of chapter 3. Please leave any questions in the comments and I'll try my best to answer them. Thank you for your time, and if you learned anything, please consider subscribing.